Hello and welcome to this Friday's morning market briefing. We've got a lot to talk about, but firstly, Joe Biden is to propose big tax rises for billionaires and corporate America. So as that Christine Lagarde signals June rate cut as the ECB lowers their inflation forecast. We've got lots to talk about on the charts. Also, lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it, make sure you subscribe. The first article to talk about is on the topic of Joe Biden. Now, the Biden administration will now target billionaires and corporations with new tax rises. This comes as a part of a plan to cut the US's record national debt and improve in polls for Biden's administration. Now, as we spoke about yesterday, Nikki Haley has now dropped out of the Republican primary race, basically leaving it to Trump to take away and win, the Republican primary, basically. And what this does, basically, is it leaves it up to both Biden and Trump for the presidential elections of 2024. So this will be another repeat of candidates that we did see in 2020. Interestingly, though, in polls, we have seen that Trump has been leading in some sense. We've seen, just in the basic polls of who's leading and who is losing, Trump is 2 points ahead of Biden. And we also know that many voters are annoyed at Biden's handling of the US economy. And this is despite the actual data showing Biden handling the economy quite well in the midst of so many issues, obviously to do with inflation and that kind of thing, which was largely outside of the US's control, you could argue. But ultimately, that's what the data's shown, but voters are not feeling that way. And so as a result, it does look to be favouring Donald Trump for the moment. So here we do have Joe Biden basically trying to, change the public perception of his actions in relation to the economy into one which is, very positive. And we do know that many citizens of America at the moment are very annoyed at corporations as they've had to deal with a great deal of inflation. Everyday citizens had to deal with a great deal of inflation recently. And as a result, they're kind of feeling annoyed at, certain corporations which they feel have risen prices too much, basically. And they think that these corporations are kind of using the issue of inflation as an excuse to raise prices further and exploit the consumers. So that's kind of where the public perception is within the economy. And so Joe Biden's coming in, he's presenting this progressive view, and he's kind of saying, look, we're going to tax those corporations, and we're going to bring that money back into the US economy, or at least bring it back into the government and distribute it through cutting national debt. So that's kind of the plan, it does seem like, from Joe Biden. Now, we do know that national debt has been a large issue for the US and is repeatedly really grown since the financial crisis, or even before that. Of course, we had the period of kind of GWOT, we had the global war on terror by the US and other allies, which did of course cost the US a great deal of money whilst they were fighting in Iraq and Afghanistan near the start of both those wars, and that cost the Bush administration a great deal of money. We then also Bush was not light on his fiscal policy. He wasn't actually as loose or conservative in regards to the economy as some might expect, and therefore his policies did cost quite a bit of money, so that ran up the national debt greatly. Then we did of course have the financial crisis in 2008. That then cost the US economy a great deal of money as well, so costing the government lots and lots in bailouts and that kind of thing. And then we did then see Obama take hold. He didn't go light on fiscal policy as well. He spent quite a bit within the economy, and obviously we had the continuation of certain wars in Afghanistan, and then the US got re-involved in Iraq. So we've had this period all the way up until when Trump took power. And whilst Trump did call to lower spending, we did see that obviously rise as a result of COVID. So, this led up to Biden's administration, which has then just continued this spending further. So that's why we're now at this record level of spending, and no president's really been able to kind of halt that spending increase. And so, Joe Biden's here basically saying that the way we're going to get out of this debt crisis is basically by taxing the rich more and then using that money to pay off that debt. And that's going to be the plan from Joe Biden. It'll be interesting to hear how Trump kind of frames his fiscal policy then in response to this. And it would be very interesting to hear that, of course. So that's the current situation with Joe Biden and his fiscal policy. What will be interesting to see, though, is whether this can boost him up in the polls and then he can maybe lean into this more, or whether just the fact that, so many Americans are already annoyed at the way Biden's handled the economy, maybe this won't even be able to do much for him. Now, the proposals are expected to be revealed in Biden's State of the Union address, with the plans including an increase in corporation tax from 15% to 21% and a 25% minimum tax for billionaires. Biden hopes that this will help cut the US's national debt by $3 trillion over the next decade, with the current figure of US national debt standing at a record $26.2 trillion. Whilst the proposals will likely go nowhere in Congress, it will enable Biden to set himself apart from Trump when it comes to the economy, whilst offering a progressive outlook on the future financials of the United States. This comes at a time where 60% of the voters say they disapprove of Biden's handling of the economy, whilst 49% say they were worse off financially since he took office. Biden's plans seem popular with the public, however, since 58% of the voters within the US believe corporations have been taking advantage of high inflation to raise prices. The fiscal policy plans of both Democrats and Republicans at the moment are a great worry for economists, such as the CBO, which has warned government debt is to increase from 99% of GDP in 2024 to 116% of GDP by the end of 2034. So a very pessimistic outlook from the CBO there, and a worrying, kind of future for the US economic state. And so this could definitely, affect markets, and this is kind of why we stay on top of politics, because these kind of fiscal policy positions that these presidents do take, and the opinion polls all weigh into the way that markets are going to perceive the future of the economy, and that of course affects markets. So that's why this is so important to understand, and a very important article to highlight and keep on your mind. That's all to talk about on this article. Next article to talk about is to do with Christine Lagarde and the ECB. Now, new signals from the ECB put June at the earliest time for interest rate cuts to start, with the ECB also cutting their inflation forecast, predicting it will reach 2% in 2025. Now, this is a very interesting article, not least because, of course, it affects markets probably the greatest, in comparison to some other articles that we might cover. But ultimately, what Christine Lagarde is kind of signaling here is, something that we've kind of been expecting, which is that these rate cuts are going to take place at the very start of summer, end of spring. Whilst we did see kind of predictions take place, a while back, well, not a while back, but maybe end of last year, that the ECB was to cut interest rates maybe starting even in March or April. Ultimately, as inflation figures have come out since then, we have started to kind of rein back in those expectations, and as a result, the predictions of when those interest rate cuts were to start, that's poor wording, but ultimately the way that investors have reined in those interest rate cut predictions, it does seem now like May or June is the most likely period or month for interest rates to start being cut by the ECB. Now, I think the ECB is a very interesting central bank to kind of cover on this topic. Ultimately, because the ECB has probably been struggling with their economy in growth wise and just their industries wise as a result of inflation and as a result of these interest rate rises. We know that the ECB actually has risen interest rates the least in comparison to other central banks like the Fed or the Bank of England, but we also know that maybe their inflation levels have been more tame. We have seen the Eurozone's inflation rate figure come down very, very low and very near to the 2% target very recently. Ultimately, though, as we've seen in Germany, the largest economy of the Eurozone, a great deal of weakness has been presented as a result of these higher interest rates and higher levels of inflation, with businesses just not being able to cope. And this was certainly the case in, certain key industries of Germany, such as, the automobile manufacturing industries, which have seen great declines recently as a result of these high inflation figures and as a result of these higher interest rate figures. And that's why we kind of did expect the ECB to start cutting rates the earliest in comparison to the Fed, and then certainly the Bank of England, which certain interest rate cut forecasts are still sitting around August or July or that kind of thing. So very interesting topic to kind of cover here. Now, the ECB President Lagarde, in her speech yesterday, said the discussion on rate cuts just began. The new inflation rate forecast saw the end of year figure drop from 2.7% to 2.3% for the end of year 2024. The ECB GDP forecasts were also cut, however, with the 2024 expected GDP growth rate figure falling from 0.8% to 0.6%. Whilst the ECB is now discussing interest rate cuts, it's important to note that 7 rate setters have made it clear their concerns that wage growth could keep inflation higher than 2%. The core inflation rate forecast for 2024 did slightly drop from 2.7 to 2.6%. The ECB holding interest rates at their current levels for now is expected to be mirrored by the likes of the Fed and Bank of England this month, with sticky inflation signs recently causing investors to push back their expected date of the central bank to cut interest rates. So very important article to highlight. Definitely listen out for any news in regards to the Eurozone, ECB or Christine Lagarde. That's all to talk about in this article though, and the articles as a whole. Next to talk about, of course, is the charts, where we do have quite a bit happening, so quite a lot to note. Now, once again, we're starting off on the US 30 with a very interesting position forming. Whilst over the past month or 2 or 3, we've certainly seen a great deal of bullish momentum enter the markets for US equities. But ultimately, over the past week or 2, we have started to see this kind of reversal take place, or at least retracement take place, with new lower highs being made and new lower lows being made. And just to draw that out real quick, we're talking about this all-time high being made recently, and then this higher low in comparison to these two areas. But ultimately, we've started to then trend down with this lower high and then lower low, and then now we're seemingly forming, or at least have just formed yesterday, the most recent lower high. So what is this kind of presenting? Well, it's presenting a trend to the downside. It's presenting this counter trend, and considering that we have broken this trend line here and now we're retesting it up here, or at least we did yesterday, we are in a very interesting situation for US equities, where just as a result of certain data coming out and having the NFP figure come out today, we have started to see US equities start trending to the downside, or at least the US 30 in particular. Now, the level that we are kind of talking about, which was reached yesterday, was this level here, this trend line, which is seemingly now acting as a kind of line of resistance, where prices come up yesterday and interacted with the 6180 Fibonacci retracement level, which we know kind of that's where price often retraces to and then continues to the downside or upside. And prices now come into contact with that, whilst also coming into contact with that trend line. So we could definitely start seeing now price roll off to the downside and make its way down to, let's say, the minus 27.2% Fibonacci extension level. So that's the next area to note. And if we do start to see this sell-off take place from that 6180 today, depending on the NFP figure, of course, that we receive, we could definitely start seeing, the US 30 start trending down. But it will be dependent on the NFP figure that we do receive today. So listen out for that. Next to talk about, though, is the dollar. So once again, another asset which is going to be influenced greatly by the figure that we do receive today, that from the NFP data basically. But what we have seen on the dollar recently is this sell-off to the downside, and it does seem like Christine Lagarde's comments today about pushing back the kind of interest rate cuts to June has caused the dollar to sell further to the downside, as maybe some money has re-entered the euro, just as a result of many investors previously expecting interest rate cuts for the eurozone in March or April or even May, and now we've pushed that all the way back to June. So that could have caused a great deal of hot money to start flowing back into the euro, and as a result we're seeing the sell-off on the dollar as a result, as things start getting balanced out. So that could largely explain this sell-off to the downside. Interestingly though, because we are receiving this NFP figure today, the levels which price did move to yesterday is very significant to note, and price did make its way down to this very key area of liquidity where price has interacted from many times before. And this was when we did receive an NFP figure before, or was it an inflation rate figure, or Jerome Powell's speech. But ultimately this kind of level has been very much used before as an area where liquidity can be gained for these big fundamental events. So price making its way down here, we could definitely see institutions start hedging some bullish orders, some buys, some longs from this area, and maybe price might trend its way to the upside quickly in the lead up to the NFP figure later today. So keep your eyes on the dollar. Very interesting price action indeed. Next to talk about though is the euro, which is in a super interesting kind of position at the moment with all these fundamental events. We obviously had the ECB's interest rate decision yesterday with Christine Lagarde's speech, which is massively important to kind of understanding where the euro is at, and that's caused the euro to rise today, and obviously rise yesterday, and with the NFP figure that we're getting today, the euro is going to be very volatile during that as well. So mirroring the dollar, in the inverse, price has made its way to the upside and has now reached this area of liquidity that we've noted out before. So maybe price will sell off from this area now in the lead up to the NFP data release. So definitely keep your eyes on the euro. That's going to be a pair of great volatility today with the data coming out. Next to talk about is pound yen, which is just making so many interesting moves, which are very interesting to look at both on the 1 hourly and the 4 hourly at the moment. But what we've seemingly seen take place here now is that double top that we did note out yesterday and the day before has seriously acted as an area of sell side volume. It's allowed a lot of sell side volume to enter the market, and we have now sold off, breaking those more recent higher lows. So now we're starting to trend down, like we've noted on US equities. An area which price could now react to, though, of course, is this area of liquidity which has previously acted as an all-time high, or a recent high for pound yen. So maybe that can act as a significant area for price to continue to the downside. That said, it doesn't really line up with any of these key Fibonacci retracement levels, so keep that in your mind. If we were to bring this above, it would still include kind of the tip of the spear for that high on pound yen previously, and would also include the 6180. So take that into account most definitely. But very interesting position for pound yen, as we are kind of now looking at potential sell-off opportunities. So keep your eyes on pound yen. Next to talk about though is Bitcoin, which is just slowly trending to the upside. after the recent overwhelming, bullish momentum that we have seen. But obviously, in yesterday's market briefing and the day before, we did note how, because Bitcoin did reach those all-time highs, we did experience a massive sell-off, with price making its way down all the way to that 50% Fibonacci retracement level and liquidity zone, and now we're kind of trending up from that. Whether we can find the momentum to now break higher and make new all-time highs, though, that's the real question to ask yourself. Next talk about though is gold, which is still currently above those all-time highs. So gold is still currently making all-time highs, but with the NFP figure coming out today, gold will be greatly influenced by that. We know that gold is a hedge for the US dollar, so depending on the NFP figure, whether that's presenting a more hawkish or dovish image for the Fed's monetary policy, that's what will influence the way gold moves today. So keep your eyes on gold. Lastly, to talk about though on the charts is oil, which is just ranging around at the moment, and whilst it's interacting with some areas of liquidity and reacting to some levels on the Fibonacci retracement level, on the Fibonacci retracement tool, ultimately we're not seeing too many levels actually be respected. So keep your eyes on oil nonetheless. That's all to talk about in the charts though. Finally, to talk about, of course, is the economic calendar, where we're getting a bit of data today. Important data though, not a lot, but the data that we are getting is very, very important, and we've kind of looked forward to it for the entire week. Now, firstly, we will be getting some Japanese economic survey data, followed by the French balance of trade figure. Followed by that, a very important figure will be coming out from the Eurozone, that being the Eurozone's GDP growth rate figure, so listen out for that for sure, with a Fed official also speaking today, followed by the Canadian unemployment rate figure, and most importantly, the US NFP figure. So lots of very important data to listen out for today. We've covered lots on the articles, lots on the charts, and lots on the economic calendar. Hope you have a great trading day, but I'll see you next week. Enjoy your weekend, and yeah, have a great one. See you later.